You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Hey, hi, welcome to Talking Real Money. I'm Don McDonald, and gosh, I keep forgetting your name.
Yeah, it's written somewhere. But
your face is familiar, but the name, it's not coming to me.
Yeah, all right.
Oh, that's Tommy Boy over there, and we are here. We're just
live.
Wow,
live.
We're live and in person and personable as heck.
This is the Super Bowl of Finance, ready for you a day early.
Exactly. But the good news about this Super Bowl of Finance is it's on almost every week.
That's a good point. We're here. We're here to help, and we want to answer your questions and calls. Anything money related. We had a call on how to come up with money to build kind of how would you describe that house? He wanted to build like not a spec house, but a
custom house.
Custom house.
That's how I would describe it.
Okay,
custom house.
That's good.
He was going to get his own land and have a custom builder build his own house.
And then Vicky called us at 855-935-8255.
Well, she called on the right number then.
Yeah, she did. And she wanted it's an interesting question. Her money's at Fidelity, right? Which is a very fine fund family. It's, by the way, one of the 5 that Morningstar says is the parent mutual fund families they think you can trust, which is a good company to be in. But Fidelity is confused, a little like Vanguard in that they have actively managed funds. They have funds where people are, and this is where Fidelity made all their money. And then they decide
actively managed,
and then they decide along the way, well, a lot of people are just buying passive index style funds. Maybe I should have some of my money there. Mm-hmm. And they added that, and they've put in a lot of money in. In fact, don't they have a mutual fund where you don't pay anything? I forget the name of it now.
The Fidelity Zero. Index.
Which
they have a zero total market index and a zero large cap index and a zero international now. The only issue I have with the zeros, I don't really have a big issue with them, except that they're emulators. They don't buy the whole index.
Thank you.
It helps keep their costs low.
Yeah.
Because they don't have any money coming in.
Yeah, no, I don't think it's not working that well. But here's the thing. It's confusing. If your money's at Fidelity, how do you pick among the, I don't know, how many mutual funds Fidelity have? A lot, I got to imagine. 300, 400, 500, probably. There's like 6,000 total mutual funds to pick up. That doesn't to pick from. That does not include exchange-traded funds.
No.
There's thousands more of those. And it's just, there's a lot out there. So how do you go about, I think it's a narrowing first rather than picking things you should never own.
I have always said that.
Yeah.
People say, how do you pick the best? And I said, no.
Get rid of the wrong ones.
It's so much easier to eliminate the wrong ones.
Yep.
Everything actively managed. There you go. That's 90%.
But how do you know if you own the Fidelity Puritan Fund if that's active or passive?
Okay, if it has index in the name at Fidelity or Vanguard, then it's going to be passive. True. If it doesn't have index in the name, odds are it's active.
And the Puritan Fund owns like what,
it's
puritanical type of things or something, or I'm asking a question. I really don't know how it's managed. Is it managed by the Puritans? Or it was originally the rock, or what's the?
It was the original fund that came over on the Mayflower.
They brought it with them, planted it somewhere there in Massachusetts.
It landed on them.
And it's worked out for 400, 500 years.
It is it's balanced. The Puritans were a little unbalanced at the time, but they're much more balanced now.
Exactly.
They're not burning witches anymore. So it's got a better balance to it.
Okay.
It's a $27 billion fund. Little fun facts.
Yeah.
0.53% expense ratio. It's a little on the high side.
It's a little high, but you can buy this. I bet it's U.S. large company growth or blend.
Well, yes,
for
the large,
but
for
so
the
you
stock
could go,
portion.
If you want to own that, you could own so many other funds that would be a tenth of the cost.
Good point.
And they would have a lot more stocks. How many stocks in the Puritan? How many people really could be registered as Puritans anymore? I mean, I bet the number
only
in the 21st century is small.
182.
That's a tiny little.
But you know what's interesting?
Securities.
I look at their list of Puritan companies, and to me, they look a lot like the. You
got your Chick-fil-A's. Who else is on the list?
No, actually, we got your Microsoft, your Alphabet, your Amazon, your Apple, your Facebook.
They might want to check the nets on that again to see if all those still qualify. I'm not sure.
I think it looks a lot like an S&P 500 fund with some bonds in it. Kind of like a balanced index fund that you can get for a lot less money. Give us a call, 855-935-TALK.
Tom and Don are talking real money.
Do you need a little help with your investments? Set up a free, no-obligation appointment with one of our advisors at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
855-935-TALK is our phone number. Hi, I'm Don. That's Tom. Give us a call. We'll talk about money matters. During the break, I looked up the Fidelity Balanced Fund, and it looks a lot like the Fidelity Puritan Fund, just with a few more stocks. The Fidelity Puritan Fund had less than 200 stocks in it.
Pretty narrow.
The Fidelity Balanced Fund has 340 stocks in it. Yeah. Still pretty narrow.
Yeah.
The expense ratios are identical at 0.53% per year, a little over 0.5% per year. And then I compared those, little compare and contrast, with the Vanguard Balanced Index Fund.
Yeah, which is...
with an expense ratio
how
of...
much? I don't know,
0.07.
7 basis points. Okay,
so it's
100.
It's almost 0.5% a year less.
Yeah.
Than Fidelity, and guess how many stocks they have?
I'll go with 500. I don't know.
3,400.
Wow. So they got a little bit of small in there, something too.
3,400.
Okay.
Yes.
Yeah. Okay.
And bonds. The Fidelity funds have about 1,000, 1,500 bonds.
I hope mostly government.
10,000.
Yeah. So you get a lot more diversification. You got much lower costs.
10,000.
What about for my neighbor, what about the Fidelity Imbalanced Index Fund?
That is just something you convinced him existed because he's got some problems or something. There is no imbalance. Well, there is. It's called the All Equity Fund.
Oh, yeah. Way out of balance.
Way out of balance.
No, but this is always the tough part. I mean, if you don't know anything, we're just how to pick these funds because this came up in a recent call. You were saying, and I agree, first eliminate funds that you should know. Mm-hmm. There's a lot of those out there, right?
Yes.
Yes.
I am agreeing with you.
Well, there's
bulk of the funds out there should be eliminated. One of the best screens is fees.
There you go.
Any mutual fund with fees above 0.75% should immediately be eliminated.
Yeah.
Any large company growth fund with expenses over 0.25%
and let me
probably be eliminated.
Help people with that. If you own the S&P 500, you own large company. You could call it a blend. There's not much value orientation, but that's the fund. If you own the S&P 500, you shouldn't pay more than 10.
Yeah, but I'm just saying, even it's a great first screen. Any fund that comes in pretty much over 0.5% should be eliminated. And there are exceptions. For example, at dimensional funds, they have micro cap funds with about a 0.53
that owns
expense ratio.
Pretty pricey securities to trade.
Right, and they're hard to trade.
Yeah, I mean, they got international the same amounts, but not the S&P 500. You can buy that. Well, you could buy it for free at Fidelity if you wanted.
But you know what? It really the point though is we're making this too complicated.
Mm-hmm.
That's why Tom and I, many years ago, decided, let's not suggest complex portfolios. There's no point. You really can have two funds. Two funds.
I know. Yeah.
And be better diversified than probably 90% of the investors out there.
I concur. Funds. Yeah. And that's why we give out the VT Wax.
Mm-hmm.
Vanguard World, I always forget what the
Total World
Stock Index holds, like 9,000 stocks globally. And the VBMFX, which is the total bond, right?
Yes, correct.
Yeah. Again, owns thousands of securities at a very low price. You simply balance between those two. But you mentioned eliminating things. I would never own a specialty fund either.
No.
People, they think that I gotta have some of my money in that thing that's going to make like healthcare, right?
Yeah.
I gotta have some of it in healthcare because everybody's going to need it.
All these people talking about alternative funds,
exactly.
Lending funds and commodities funds and inverse floaters and there was a great piece recently about the biggest sales group selling really expensive, costly, dangerous, leveraged ETFs.
Yeah.
Where they borrow ProShares. ProShares was the company, and they go out and
wasn't it 3 times the S&P 500?
They buy 3 times the S&P 500 in a fund. They borrow for every 100 shares. They borrow another 200 shares of every single company. They're paying interest on those shares,
of course,
and it is so great when the market goes up. In 2019. Their S&P 500 3X fund went up like 100%.
Whoa. That's big money.
However, in a year like 2008, you could expect it to go down by 160, 70%.
Couldn't you just do the same thing and get the drinks and go going to the casino?
Pretty close.
Yeah, the leverage
free drinks, and maybe you the kind of money you put in those things, you can get a free room. They'll comp you a room.
Yeah. Again, those are the type of things I think you should eliminate. There's no reason to own them.
But it really comes down to this, and I don't want to confuse you. If you can go to Vanguard, and we get nothing from Vanguard, nothing. We don't even get a nice pen. Have we ever gotten a Vanguard pen?
No, we did get something from Schwab once.
Schwab gave us some bling one time.
Yeah, we were down
way back. We were down in Phoenix.
Yeah,
I got a Schwab tie, which I never wear.
I think I had a hat or something.
Yeah.
That's it.
Anyway, we get nothing from Vanguard.
Yeah.
The reason we suggest those 2 funds is to keep it simple. Now, if you are at Fidelity, you cannot keep it as simple, but there is still a simple solution, and this is what I wanted to get to with the caller in the last hour.
Yeah.
Was the portfolio there? Depending on your risk tolerance and need to take risk, you could create a portfolio at Fidelity that was the Fidelity Total Market Index Fund, which is FSKAX.
FSKAX.
FSKAX. They don't have a total market fund, and I don't know why, but they do have an international index fund. And I just had it, and then it went away.
Yeah.
International.
And can I say something while you're looking that up?
Yeah, you may.
Yeah.
Please.
So if you come to Retire Meet, we give you a Vanguard portfolio, we give you a Fidelity portfolio, and we give you a Schwab portfolio for free. There's a handout.
We don't give you the portfolio.
No.
We give you the names of the funds.
Okay, we're not going to put money in a fund and hand it to you or something. No, but we show you how to invest in those places. It's part of the handout. In addition, you get the retirement guidebook, which is like 40 pages of
60?
Stuff. Pardon me, 60.
60 pages? I worked really hard on that book. 60?
That's worksheets and all kind. I mean, it's all part of Retire Meet coming up 3 weeks from today in Bellevue. You got to get the tickets. Use Flash as the special code. Go get them today. Join us. It can be great sessions.
And call us at 855-935-TALK, and I'll come back and tell you the 3-part Fidelity Fund. It's 3 funds. You can make a great portfolio with them at Fidelity.
Tom and Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information, TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Once again, that number is 855-935-TALK, 855-935-8255. Stop by. We'll talk money with you. Money matters, because money matters. Anyway, I mentioned the stock fund,
yes.
The Fidelity Total Stock Market Index Fund, as a way to build a 3-fund portfolio at Fidelity.
Because there you need the international exposure you don't get.
Right. You got to have international.
One fund does the whole thing.
You start out, you put about 55% of your equity position.
If you really want to get technical, yeah, okay.
Yeah, into the total market fund. Mm-hmm. Then you get the total international index, which is FTIHX, for the rest of your equity position.
This gives you exposure to global stocks.
To international stocks.
Correct.
Correct.
Well, I'm saying between the U.S. and international, yeah.
For the bond portion, this was my personal favorite because I believe bonds should be safe, and super safe. This has really low expenses, and it's all intermediate treasuries.
You can't go wrong with that. Not
and
paying
it's got
today,
a yield of about 1.8.
Yeah, okay. Because they probably still have a few.
They still have some older bonds in there.
Yeah.
And that's FUAMX because it is hardly going to move. That thing is just going to sit there. And it's almost impossible. It's still going to sit there because it's bond.
Made a lot of money last year. I bet last year it made 7 or 8%.
It really didn't. It didn't have that fund. Didn't have a big return last year. It
7.5%.
It was it was a little under 7.
Okay.
But it wasn't because it's intermediate treasuries,
yep.
But overall, its average annual returns have been more in the realm of 5%.
Yeah. So you have that's the decision then to be made is the balance between those two stock funds you mentioned and the bond fund. Now, one way you can determine that is getting professional help. Number 2 is you can go take the risk quiz. That will give you some indication of whom you are, kind of your emotional makeup, your knowledge of stocks and bonds, and help you build a portfolio on your own.
I didn't realize how easy it is to find the risk quiz now. You don't even have to go to TalkingRealMoney.com. I
saw it on the drive in here today.
If you just go into Google and type in RISQUIZ, all one word, risk quiz, it comes right up at the top.
It's right next door to Shaquille O'Neal's Krispy Kreme franchise. You can't miss it. Stop in for a free donut.
Does he? Do they have Krispy Kreme in L.A.? I didn't know.
I'm in Seattle, just in case you're
wondering. But I mean, that's where he lives. Shaquille lives down there.
No, he's in Florida.
Well, he's in Florida part-time.
What?
Yeah, that's true. He has a house just down the street from me.
Doesn't he live like next door to Tiger Woods or something?
In Isleworth, in
right.
that really ritzy, rich person
Ken
area.
Griffey Jr., that's where the people live. Yeah. Not us people, but those people.
Yeah, I mean,
I could get to drive by. I mean, come on.
You can drive by, but there's a wall.
Yeah. Big wall.
There is. There's a wall.
And they're watching me going, sir, that's a Honda Pilot. You mind accelerating a little bit? Hurry up. That's not even allowed within 20 yards. Anyway, so yeah. The point of the matter is you could do this with those funds. That's a way. I mean, and Schwab has an equivalent type, and Vanguard. You could go to those major custodians and build a portfolio that would be pretty doggone good at a pretty low cost.
At a super low cost.
I mean, pretty good deal. So
and there's no reason for small. This is one of the things with small investors when you're just getting started. It doesn't need to be too complicated because those when we're talking about adding small cap value, for example, to a portfolio, or we're talking about adding emerging markets or micro cap stocks or the more aggressive stuff, we're talking about tiny little incremental increases. That when you've got $5,000 or $10,000 or $15,000 or even $20,000 in your portfolio are going to add.
Small amounts.
Tiny amounts of money. It really matters when you get into the bigger numbers. Yeah. And that's why I keep saying investors who are starting out probably don't need to have an advisor. No. That's the time when you can really do it on your own as long as you steel yourself to one thing. Once you build the right portfolio, you're not going to bail on it.
Yeah,
you're not going to play with it.
The market's going to go up, market's going to go down. The portfolio is about you, not them.
That's right. You got to hang in with it. 855-935-TALK. We've got a half hour left. We'd love to help you out with any money matters, any money confusion, any money frustration. Stop in.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at TalkingRealMoney.com.
Radio for a really great future. We're talking real money.
We had more calls on Christmas Eve.
Yeah, could you do me a favor, too, by the way?
When Super Bowl Eve.
When you get them. We just got a call, but it was not for the show. It's from my wife. Could you call her and tell her I'm doing the show?
I was wondering if that's what that was. Yeah. I saw you look over and hang it up, and I went, is that Tom's wife again?
Yeah.
Not realizing that he does a radio show
I don't think she does.
Every Saturday for the same 2 hours for how many years now?
A long time. I don't know how many years, but a lot.
My gosh, really?
Yeah, I guess so.
Okay.
Yeah. So call her when you get a break, would you, and let her know that I'll be home.
Hey, Dave,
and
Don
yes,
here.
I'll bring the milk. Don't worry, I got it covered.
Did you get the stuff for the Super Bowl party? That's what's important.
I did on my own, by the way.
What are you making?
Oh
for
man, it's gonna be good. I told I'm making this pizza bread thing.
Oh, was that it?
Well, no, I'm doing some shrimp. I got a few things.
Okay, you usually don't just do one thing.
I know.
You sort of overdo.
Well, and my daughter likes to cook, so she helped with the bread
your
thing.
Daughter's like the
chef. She wanted to make a cake. So after volleyball on my birthday at like 8 o'clock, let's make a cake for your birthday. I'm like, no, it's 8. No, it's too late. Sorry, you should have done that like 3 days ago. No.
It's never too late for cake.
I'm not eating cake, as you know, for obvious reasons, but I will have a piece tonight. But anyway, she's very.
Oh, that's right. You're having the birthday gathering.
Everybody's
tonight.
coming over tonight. Got the grandkids.
Happy birthday to Tom.
This one felt harder than the last one, which I thought was kind of hard.
That's only because you're Social Security eligible.
I know. So I think the government officially says you're old now, bro. You can go. Yeah. I love it at the office though, because when people make me mad, I say, you know what? I'm going to get my benefit. See you later. I'm not coming back.
I'm going down.
Let me drive you there. It's right across the street there. It's close.
Yeah, please go. Please, that would be great.
Exactly.
Thank you so much. Hey, now.
Yes.
Well, we were talking earlier about about small and small cap value and all of those kinds of things.
I was going to mention something about that.
You had a little thought on that I think
companies,
you spaced like you forgot you were on the radio.
Exactly. Most of you listening don't own very many smaller companies. We know because we look at portfolios every day, and in aggregate, I think America has 85% of its money in the S&P 500 if you're invested in stocks because it's easier.
Mm-hmm.
Yeah,
and it's what makes them the S&P 500 because you put more money in them.
And yet, had you owned small caps, you'd have made 5% a year less than large over the last 10 years.
Well, then why would I have wanted to own those?
Oh, I misstated that. No, that's true. But from 1979 through the end of last year, you made.
No wonder your wife doesn't know what you're doing today, because I'm confused as to what you're doing today.
Speak. You made a little more than 1% a year more in small than in large.
In what time frame?
In 1980, basically through the end of last year. I think that's 40 years.
Oh, over that entire time, I made 1% more?
A year. More than 1%.
A year, that's good.
That adds up. So the last 10 have been crummy for small companies. Not crummy.
But over that entire time, though, they still beat large companies.
And you go back to 1926, it's even more dramatic, which I know you're one of the few people that still can go back to 1926.
Yeah, I'm still waiting for that 100-year Social Security bonus check. I'm not filing until I'm 100.
I'm one of the original filers for Social Security. I want my benefit.
Okay, folks, that's a joke. If you wait past 70, it doesn't go up anymore.
There was a woman in the office the other day, though, that said, I've been listening to Don since the 80s. I go, the 1880s? She goes, I'd have to think about that a little bit. I'm not sure. So I'm going to tell him that. Thank you. The point is you should own smaller companies in your portfolio. The question is how. Now, you mentioned the total.
Wait. The
80s?
If you have a $5,000 IRA and you just started with it, do you really?
Well, no, you could own the VT Wax. That has some
and you'll own some small caps.
It doesn't have as much as we'd like to, as you said, when you have a larger portfolio and you can really make sure that a lot of your money goes into smaller companies. The VT Wax, I'll bet it has like 3% of the whole thing in small.
VTWAX is the Vanguard Total World Stock Index Admiral Shares, just for those of you who are keeping score at home. And let's take a look at their small cap weighting.
Small.
It's Small cap, 4%.
Okay, I said 3. I was close. So
yeah, you were pretty
close. The point is, or you could do Paul Merriman's strategy, which I like, which is the 2 fund. You own the target date fund, and you own a small cap or small cap value fund with it. Gives you more exposure.
Yeah, that one just worries me a little. Be right back.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
We're coming into the final stretch of the program, and then, it's Super Bowl pregame from here on in. 855-935-STOCK is the number. Tom?
You said stock.
855-93 talk.
Next week it'll be 855-935-BOND, I guess, or something.
Bond, yeah, balanced. I was reading something online this morning, and it said the big game. It said, join us for the big game, or we're going to be. Do you know you're not supposed to say Super Bowl?
I'm not supposed to without paying a licensing fee?
It's a registered trademark.
Oh, good Lord. Who owns that one?
They don't want the NFL.
No, they don't want us. Oh, I see. In other words, they don't. So I said the Super Bowl of finance earlier, so I'm in trouble for that probably.
Absolutely.
I see.
You see,
Roger
you violated their trademark.
He's going to call me.
Do you know, though, that they used to have a rule that that you could not invite people over to a business and show the big game on a screen bigger than 50 inches.
How long ago did that end?
I don't know.
Wow.
Are
they going to be knocking
control
on doors tomorrow or something?
I just realized I've been saying Super Bowl, and I'm supposed to be saying the big game.
The big game.
Because but they did try to trademark the big game, too, and the courts wouldn't let them. Anyway.
Good Lord.
Here's what I wanted to talk about.
Yes.
We were talking about index funds and how good index funds are, but I really would be remiss if I didn't mention that there's a wrinkle. Of course, Wall Street throws wrinkles into things, and, they just can't let a good thing alone. They have to mess it up. And they've even messed up indexes. They now have funds that they call index funds, but they're not really... They're like
they're not
self-selecting indexes.
Yep, that's right.
They're not. Yeah. For example, the S&P Dividend Index.
Oh, yeah. I read about this one.
Yeah, it's Jason Zweig's column today.
Yep.
Or the S&P High Yield Dividend Aristocrats Index, which is 100 stocks of companies. Get this. This is the index. It's not really an index of companies that have raised their dividends at least 20 years in a row.
Yeah. And guess what happens? You end up with owning a whole lot of some companies because of that arrangement.
Yeah, and companies with high dividends,
right,
but that are falling apart as you're watching them.
Because remember, it's a ratio between the share price. Anyway, it's not a good way to invest.
No. Clean indexes, we got to keep it simple.
Yep, I agree.
And I think it's time to talk to Gary.
Yeah, let's do
Gary,
it.
welcome to Talking Real Money.
Hi, Gary.
Hi, Tom and Don.
No, Dan is
Tom,
fine. Tom,
fine. Call me whatever you want. I don't care.
Danny boy, that's good. How can we help you?
Okay. I sat out with Tom a year or so ago, and we set out a plan, and it was awesome. Highly recommend you guys. I have just a simple question you probably answered a gazillion times, but turning 61, retired military, got a good pension out of there, and I am looking at 62 and a half for a first chance of doing Social Security. I know that, or I've heard that it limits the amount of money that you can make if you're in that. If you take it rather than 66 and a half or 9 months or whatever it is. The question is, with real estate passive income, is that considered income at the 62 and a half level?
You asked a lot of questions there, Gary, and thank you for your kind comment.
We're going through them a little at a time.
Yeah. First of all, thank you for your service to our country, which we really do appreciate. But Social Security first. Every You're eligible to get it at 62. I know that because I just turned 62. Every month after you turn 62, the amount you get until age 70 increases. It increases at about 8% a year plus inflation. So there's no new magic line to be drawn at full retirement age, etc. That's number one. Number two, I'm trying to make sure I'm understanding you around real estate income.
He's talking about passive income from rental properties and that kind of thing, which does not count toward the earnings test.
Yeah, so that would not impact your Social Security benefit.
It is only employment income that counts toward the earnings test.
So, but here's the other question to you is, the only reason I think anybody should take Social Security before at least full retirement age is they don't expect to live another 8-9 years. They really have to have the money. I don't have a job anymore. I need the money. Otherwise, I see no reason to take it. What am I missing?
Okay, and you're not missing anything. It's just simply a numbers thing. I do not need it. I am able to, with military retirement and passive income from rental property, do just fine. And understand that it goes up a certain amount. I'm just trying to figure the numbers out. Does it make sense to go ahead and start drawing it now rather than at 62 rather than 66 and a half?
Yeah, it's a bird in the hand versus the two in the bush kind of thing. A lot of people think, I'm going to take that bird in the hand right now because I know the money's there, and what if I die soon? We're always gambling with the future. We always gamble with the future. That's part of being alive. You don't know how long you're going to last, but if you hope and expect to live into your early 80s,
there's no question.
It makes sense to wait until you're 70.
Yeah, there's no question. So, as I said, the only two reasons I would say are no history of longevity at all, or you have a health problem, some reason to think you won't live till 78, 79 years old, or you need the money. It doesn't sound like either of those apply to you, Gary. I think you should continue to wait. And by the way, it's not like you make the decision at 62 and you can't do anything until you're 70. You can do it anytime along the way. You could say, I really want to go get the money and want to file for whatever reason. That's fine. I don't want to manage properties anymore. I want to get income from my money I put aside in Social Security. You can make that choice anywhere along the way.
If you want to meet with Tom again, you don't have to do it in the Social Security line because he's not going. Tom's
not just
come by the office and say hi.
Thanks, Gary. Great call. Appreciate it.
Thanks for the call.
Very much. And by the way, I will say that these are the exact type of questions we help you understand when you come to retirement, because part of my talk around retirement income is exactly this, trying to figure out when to take Social Security, how to create a retirement paycheck, if you will. And then you've got the great Paul Merriman who's going to be there to inspire Don McDonald on how to construct a portfolio, right?
Oh, I forgot. I've been working on this. I was working on this all day. Because I realized we don't have a retire meet jingle. Ooh. We have no jingle. And I thought, we need something that's really catchy, that's going to stick in people's heads.
All right, let's hear it.
So I worked really hard on this retirement jingle. You ready?
I'm ready.
Okay. Retire meet deet 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 deet. Retire meet deet 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 deet. Retire meet deet 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 deet. Is that sticking in your head yet?
No, but a lot of other things are.
I changed it slightly. So it's not exactly the same tune as the other song of a similar.
RetireMeet.com.
I'll say that after the break, too.
Tom and Don are talking real money.
Would you like to talk to a real investment advisor for free? Set up an appointment at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Retire meet deet 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 deet. Never mind. Hey, go get your tickets right now at retiremeet.com, retiremeet.com, and use the discount code FLASH this weekend. Only this weekend, if you're listening on the 1st and the 2nd, to save $10. That's the discount code FLASH at retiremeet.com.
We hope you realize advised that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.